Income taxes. In this reading, we will talk about the differences between accounting profit and taxable income, determining the tax base of assets and liabilities, temporary and permanent differences between taxable and accounting profit, unused tax losses and tax credits, recognition and measurement of current and deferred tax, presentation and disclosure, and finally a comparison of US GAAP and IFRS. It is essential to understand that there are differences between how and when transactions are recognized for financial reporting purposes relative to tax reporting. This reading is difficult, but we will focus on the key concepts and we will work with simple examples, and that should be good enough to help you on the exam. Differences between accounting profit and taxable income. Financial statements are prepared based on accounting standards such as IFRS. These standards define the rules for computing accounting profit and hence the tax expense. The calculation of income tax payable is based on tax laws. This is the amount that a company is actually required to pay. So note that the accounting profit that we see on the income statement is typically going to be different from the income tax payable. Let us look at some of the major reasons why we have a difference between accounting profit and income tax payable. Accounting profit, as we have seen here, is calculated based on accounting standards or accounting principles, whereas tax payable is based on tax rules. On this slide, I will show you some of the major reasons why we come up with a difference. The one that you will see perhaps most often is the difference in the way we depreciate long-term assets. Typically, on financial reports, you will see the use of straight line depreciation, whereas tax rules generally allow accelerated depreciation. What this means is that in the early years of an asset, the depreciation expense on the accounting side will be relatively low, whereas the depreciation expense on the tax side is going to be relatively high. This means that the expenses are different and hence the profit before tax is different and hence the tax is going to be different. With revenue, we need to follow the revenue recognition rules that we have spoken about earlier. Whereas on the tax side, revenue is typically based on cash received, and we will see examples of how this impacts profit. And then as far as expenses are concerned, accounting principles say that we need to use the matching principle for expenses, where an expense needs to be shown in the same period where the corresponding revenue is generated. With tax rules, we might have a situation where expenses are based on cash paid. This is a high-level simplification. The larger point to understand is that the rules for recognizing expenses on the accounting side are not necessarily the same as the rules for recognizing expenses on the tax side. Accounting profit and taxable income. I have already alluded to these concepts, but the purpose of this slide is to make sure that you understand the difference between the two. Accounting profit is based on accounting standards. Taxable income is based on tax laws. What we are looking at over here is a very simple excerpt from an income statement. We have a certain revenue, cash expenses, and this particular company has purchased an asset for 50, which it is depreciating over 2 years. So it is doing straight line depreciation as far as financial reporting is concerned. The profit before tax, which is another term we can use for accounting profit, is 25. On the tax reporting side, this same company is using accelerated depreciation, and let's say the depreciation in the first year is 40, second year is 10. So the only difference over here between financial reporting and tax reporting is in the way the asset is depreciated. Obviously, in the real world, there will be many other elements, but here I'm just picking one item to illustrate a concept. The financial report over here, the tax return, will show the same revenue. In this simplistic example, the cash expenses are the same, but in 2011, the depreciation expense is 40. So the taxable income is only 10. Notice that the taxable income, which will be shown on the tax return, is different from the profit before tax or accounting profit, which is shown on the income statement. Provision for income tax expense and tax payable. I have reproduced the segment from the last slide. So again, we see the excerpt from the income statement over here and an excerpt from the tax return on the right. The question now is, given a tax rate of 40%, what is the income tax expense and what is the tax payable for 2011? If we look at the income tax expense, this is also called the provision for income tax. That is going to be 40% of 25, which is 10. Whereas on the tax reporting side, the tax payable is going to be 40% of 10, which is 4. Notice that because of the difference between these two numbers, the profit before tax is 25, the taxable income is 10, therefore the income tax expense is different from the tax payable. Just to emphasize some terminology here, the income tax expense or the provision for income taxes is shown on the income statement. This is a financial reporting concept. Income tax payable is what is actually payable, and this is shown on the balance sheet. The reason we say this is the following. Let's say that in a given year, the taxes are actually supposed to be paid on 15th April, but the tax is calculated based on the tax return on 10th January. The tax payable will be shown as a liability on the balance sheet until it is actually paid. Once a company actually pays an amount, that is called the income tax paid. And typically the income tax paid should be equal to the tax payable, but it doesn't have to be. Coming now to deferred tax liabilities, and this is extremely important. There is a high probability that you will be tested on how deferred tax liabilities are created. Deferred tax liabilities arise when income tax expense, which essentially is on the income statement, is temporarily greater than the tax payable, which is what we calculate on the tax return. There are several reasons why this might happen, but I will give you the two major ones. This might happen because we recognize revenue on the income statement before recognizing it on the tax return. And this can happen when we have revenue recognized in one period, but the cash is actually received in the next period. Revenue is recognized and accounts receivable is booked. So as far as our income statement is concerned, we can show the revenue. But since the cash is coming in the next period, the tax return will actually show the revenue over here. This is going to create a deferred tax liability. The other reason is where expenses are tax deductible before being recognized on the income statement. And a classic example would be straight line depreciation versus accelerated depreciation. We have already been discussing this example, but now let's take it one step further. Again, on the left we have financial reporting, and on the right we have tax reporting. Notice that the only difference is with depreciation. We have the same situation where the company buys an asset for 50. On the financial reporting side, the depreciation is 25 and 25. On the tax reporting side, the depreciation is 40 and 10. So notice in 2011 the tax expense is 10, and we calculated this on the earlier slide, whereas on the tax reporting side the tax payable is less than 10. The tax payable is only 4. In the next year the tax expense again is 10, but the tax payable is 16. Overall we pay 20 in tax in both situations, but on the left hand side with financial reporting, this is actually a provision. On the right is what we are actually supposed to pay. Now let's look at 2011. The tax expense or the provision for income taxes is 10. This number, the income tax expense, is greater than 4, which is the income tax payable. This means that according to financial reporting, what we should be paying is more. When this happens and the difference is temporary, where we are expecting it to reverse in the next year, then essentially we have a deferred tax liability. A liability because we are paying less now, but will have to pay more later. So there is an obligation to pay more taxes later. That's why this is called a liability. It's related to deferring the taxes. That's why it's called a deferred tax liability. So this relationship is what you have to memorize and understand. If the income tax expense is greater than the income tax payable, then we have a deferred tax liability. We can use this relationship now to also understand the first bullet point. If a company is recognizing revenue on the income statement because revenue recognition criteria have been met, but the money is actually coming in next year, notice that because of the high revenue recognized over here, the income tax expense in this year is going to be greater than the tax payable. And that is this situation over here, which means we will have a deferred tax liability. I also want to point out the value of the deferred tax liability. At the end of 2006, notice that the tax expense is 10 versus the tax payable is 4. The difference of 6 represents the deferred tax liability because this extra 6 is what we need to pay later. So the deferred tax liability is 6. At the end of 2012, we have paid off that 6. Notice that the tax payable is 16 relative to a provision for income tax of 10. So this 6 is paid off and the deferred tax liability then comes back to 0. So we say that the deferred tax liability is reversed. Deferred tax assets. Deferred tax assets arise when tax payable is temporarily higher than income tax expense. If I were to use the same format I used on the previous slide, I would put it this way. Income tax payable greater than income tax expense. This will lead to a deferred tax asset. Now, when can this happen? There are several scenarios, but the two most significant ones or the most testable ones are shown right here. You can have a situation where the revenue is taxable before being recognized on the income statement. So if you have two periods, the revenue needs to be taxed in period 1, but it will be recognized in period 2. Why might this happen? It can happen because a company receives payments in advance. Since the cash is received in period 1, the tax authority says that you need to pay taxes. So that money received is taxable. However, you might not have delivered the service. So you will recognize that amount as revenue in the next period when the service is actually delivered. So how will that impact the financial report and the tax return? On the financial reporting side, you might have a revenue of 100, But notice the revenue is higher on the tax side because the cash that has been received in advance is shown as revenue on the tax side. Assuming everything else is the same, expenses are the same, obviously the taxable income is going to be higher because of that higher revenue, which means that the tax payable is going to be higher than the tax expense. When this happens, we create a deferred tax asset as long as the difference is going to reverse in the future. So that is what is happening here. In the future, the revenue on the tax side is going to be less because we have already recognized the cash received as revenue over here. So in 2012, the revenue on the tax side is less than the revenue on the financial reporting side, and correspondingly the tax payable on the tax return is going to be less than the tax expense on the financial reporting side. Now pause the video and identify the deferred tax asset at the end of 2011. Here is what you should come up with. The deferred tax asset is equal to 8. Why? Because you have, in a sense, overpaid by 8. The tax payable is 28 relative to the tax expense of 20. This is an asset because you are paying the tax early. Next year, notice that the tax expense is 20, but the tax payable is 12. So in 2012, the tax payable is 8 less. Roughly speaking, you can think of this deferred tax asset like a prepaid expense, which is an asset. So tax is an expense. You have paid it early, therefore you can show it as an asset. At the end of 2012, once you have paid 12, which is 8 less than 20, we can say that the deferred tax asset is back down to 0. So the deferred tax asset has reversed. Coming now to the tax base of an asset. An asset's tax base is the value of an asset according to tax rules and is used to calculate the tax payable. The asset tax base is analogous to the carrying amount or net book value. Let us make sure we understand this through an example. An asset is purchased for 50 and is depreciated over 2 years. On the financial statements, the depreciation is 25 and 25. According to tax rules, the depreciation is 40 and 10. Show the carrying amount and tax base at the start, at the end of year 1 and end of year 2. Now this should look familiar. On the left, we have financial reporting, and let's say we are looking at balance sheet numbers, and on the right we have tax reporting. At time t equal to 0, the value of the asset is 50 on both the financial reporting side and the tax side. The value on the financial reporting side is called the carrying value. The value on the tax side is essentially called the tax base, or sometimes you might see the term tax basis. At t equal to 1, on the financial reporting side, we have depreciated 50. So the carrying amount is down to 25. At t equal to 1, we have depreciated 25. So the carrying amount then is down to 25. At t equal to 2, we have depreciated another 25. So the carrying amount is 0. On the tax side, after 1 year, we have depreciated 40, so the tax basis is now 10. At t equal to 2, we depreciate another 10, so the tax basis is now 0. So notice that carrying amount and tax basis are essentially the same concept. It's only that when we talk about financial reporting, then we say carrying amount or net book value. When we are talking about tax reporting, then we say tax basis. The concept is the same. So what is the link between tax base and a deferred tax liability? Again, using the same numbers on the financial reporting side and the tax side, let us calculate the value of the deferred tax liability at the end of 2011. I will give you the formula and then a brief explanation for why this holds. The deferred tax liability at the end of a given period can be calculated as follows. It's the carrying amount minus tax base multiplied by the tax rate. Now notice this is a deferred tax liability, which means that this is a value on a particular date. Typically, you will see the deferred tax liability on a balance sheet date. Say the date here is 31st December. So we are calculating the deferred tax liability on 31st December 2011. That is equal to the carrying amount on that date, which in our example is 25, minus the tax base on that date, which in our example is 10. Say the tax rate is 40% or 0.4. You take the difference between carrying amount and tax base, multiply by 0.4, and you get 6. So we are saying that the deferred tax liability based on this formula at the end of 2011 is 6. And this is exactly what we saw in a earlier slide. Why do we have the same answer? Notice that we come up with a different number for profit before tax relative to taxable income because there is a difference in the depreciation expense. It is that same difference that is creating the difference between the carrying amount and the tax base. So that's why you get the same answer. But whether or not you fully understood that, you need to memorize this formula. The deferred tax liability is carrying amount minus tax base multiplied by the tax rate. What about at the end of 2012? There, the carrying amount is 0, tax base is 0, 0 minus 0 is 0, multiplied by any tax rate would be 0, so your deferred tax liability is 0. And as we saw earlier, if we look at the change in deferred tax liability over time, at the start of 2011, the deferred tax liability is 0. Then end of 2011, it goes up to 6. And end of 2012, it is back down to 0. Now let's look at a very important relationship that connects the tax expense, tax payable, and deferred tax liabilities. The top part of the screen should look familiar. This is an excerpt from the financial report, which is showing the tax expense, tax payable, and profit after tax. This should also look familiar. We just did this on the previous slide, where the deferred tax liability is equal to the difference between the carrying amount and the tax base multiplied by the tax rate. Now here is the relationship that you need to memorize. The income tax expense, or the provision for income tax, which you see on the financial report, is equal to the income tax payable, which you see on the tax return, and then this is the number that goes on the balance sheet. Income tax expense is equal to income tax payable plus the change in the net deferred tax liability. In our example, we only have a deferred tax liability, so the net doesn't mean too much. If you have both deferred tax assets and deferred tax liabilities, then the net deferred tax liability would be equal to the deferred tax liability minus the deferred tax asset. For most companies, there is a deferred tax liability that is higher than the deferred tax asset. That's why we typically talk in terms of a net deferred tax liability. In 2011, the income tax expense is equal to 4, which is the income tax payable, plus the change in net deferred tax liability. Notice on the previous slide, I told you that the deferred tax liability for 2011 went from 0 to 6. So what is the change? The change is the final value minus the beginning value, 6 minus 0. So essentially the income tax expense is 10, which is what you knew anyway, but I have done this to help you memorize the relationship shown over here. In 2012, obviously the same relationship will hold. Income tax expense is equal to 16, which is coming from here, plus the change, which now is 0 minus 6, which again will give us 10. Just to generalize this a little more, if you are given the change in deferred tax liability and the change in deferred tax asset separately, then here is the relationship that you need to know. The income tax expense for a given period is equal to the income tax payable plus the change in deferred tax liability minus the change in the deferred tax asset. The material that I have discussed here is shown in a little more detail in example 1 in the curriculum. Once you have understood what I have talked about, you should be able to digest example 1. Now try to do this question. Here is what you should come up with, and we've simply used the expression that we saw on the previous slide. Try this question now. The correct answer is B, and here is the quick explanation. On the financial reporting side, we are using straight line depreciation versus on the tax side, we are using accelerated depreciation. Obviously, with accelerated depreciation, the expense is more, which means the taxable income is less. This means that income tax expense is going to be higher than tax payable, which means that we have a deferred tax liability. Now try this question. Here the correct answer is A. On the financial reporting side, the revenue will be relatively low compared to the tax side. Therefore, the income tax payable is going to be higher than the income tax expense, and that will lead to a deferred tax asset.